Quantitative easing is one of the experimental drugs that central banks have been prescribing in the US, Europe, and Japan to combat the economic downturn. Delivering a cautionary note at a conference in February in London, new Sparta chief executive Jerome argued that by creating new money and using it to buy up bonds, the central banks were bailing out the finance sector rather than boosting economic growth.
QE, in my view, was primarily never designed to stimulate the economy. It was designed to save the banks and thus to prevent depression. And the design of QE1 and QE2, which created a steeper yield curve, was clearly consistent with that. We have a very important role of central banks in maintaining the myth that this was not about avoiding depression. Because when there's enough uncertainty in an economy, it will basically stop investors employing more people, building new plant, and that in turn creates uncertainty for others, which has a positive feedback, and that creates the depression.
Who would have thought that 6 years after the emergence of the global financial crisis, most advanced economies would still be struggling? All traditional fiscal policies have failed. Therefore, the introduction of unconventional monetary strategies could be a sign of confusion rather than competence.
They are signs of confusion. We clearly have entered a completely new world in terms of central bank policy making since 2008, with unconventional policies being adopted by many more central banks around the world. And they're searching, they're trying to find out which methods are most effective, whether it's QE or directly impacting on the banking system or trying to alter inflation expectations or currency.
Jerome is more concerned about the aim of policymakers rather than their methods, since the role of quantitative easing, as applied today, is quite different to the concept that the central banks have presented to the public.
And the objective is quite clearly to erode the value of government debt over the next couple of decades. If markets cotton on to the fact that they're being robbed, that their savings are being eroded, then you have the potential to shift, I think, much more rapidly than people understand, to the other way of ensuring a negative real interest rate, and that's inflation. And that's particularly problematic because of the high level of debt.
According to a recent McKinsey report, with more government borrowing than at any time since 2007, debt mountains have expanded at a greater pace than economies.
The strong rise in the debt levels across the globe is definitely the result of the deep financial crisis we had beforehand, and in the euro area we are still in solving this crisis. I think this debt levels is not the problem as long as we can reach a path of solid growth, and then we can handle this problem. If we will not reach a solid growth path, then even the central bank cannot solve it.
While fiscal policymakers were searching for the right move, a massive redistribution of assets was taking place worldwide.
We have pension funds and institutional investors in the West taking massive risk concentrations, not diversifying where they should do. And likewise, we've got central banks in emerging markets who now own about 80% of global central bank reserves, putting their money into things like US Treasuries. And there's basically, for a buy and hold investor, almost no major scenario I can think of where they're going to get their money back.
In recent years, according to Jerome, two major disconcerting macroeconomic trends have emerged.
One, of course, is the great global imbalance, which is a result of the huge transfer of savings from the high-saving countries in emerging markets to the highly levered, as I call them, the heavily indebted developed countries. And then we have the debt, this huge debt. If you count everything in the US, including unfunded Medicare, etc., we're talking about 640-odd percent of GDP, sort of over 500% here in the UK. These are very, very large numbers. We don't expect fiscal austerity or any sort of fiscal measures to repay this.
Hence, in the upside-down world that we live in, asset allocation requires an unconventional strategy. For Jerome, emerging markets, commonly viewed as risky and unmanageable, are his safe haven, where he has put over 90% of his investments.
The emerging markets are highly diverse, highly heterogeneous, and there is massive diversification value in investing across 60 emerging markets, much more than investing across Europe and the United States, which are actually highly correlated, and particularly because there's so much leverage, so much misperception of risk, so much concentration of the investor base. My triple cocktail, if you like, of warning signals for a systemic crisis, which I have a little theory about in the book. The emerging markets, therefore, should be seen as a way to reduce risk, to be more
in the upside-down
representative
world that we live
of
in,
real economic
asset
activity
allocation
on the planet.
requires an unconventional strategy. More and more investors
Jerome
are
Booth,
acknowledging
emerging
possibilities
markets,
commonly
offered by
viewed as
emerging
risky and
markets,
unmanageable, a
are his
phenomenon
safe haven,
recognized by
where he
Jerome
has put
Booth over
many years
90%
ago.
of his investments.
So far it seems that emerging markets has been quite uncorrelated with the industrial world, which worked out quite well during the crisis. But when we expect a stronger GDP growth in emerging markets and maybe stronger capital inflows, it could happen that a correlation will rise.
According to Jerome Booth, US and European pension funds are acting recklessly by depriving savers of investment opportunities outside of the mainstream.
If our pension funds do not invest in emerging markets today, then they are gambling away from our liabilities. I'm outraged because I'm being robbed. I've got my pension fund, which is being forced by regulation to buy so-called safe bonds with the complicity of effectively rating agencies who conveniently rate government bonds, AAA or something.
All it takes is an open mind.
I don't think it's useful to think of emerging or developed. An investor needs to be thinking about what options there are in both types of universe.
Institutions and funds investing other people's money should cash in where the growth is today, and emerging markets, according to the IMF, are expected to grow 2 to 3 times faster than those of developed nations.
My ask is that we start to get macroeconomics, strategic thinking, scenario planning back into asset allocation. We need to really think about the big 2 global imbalances, the high levels of debt in the developed world, and these global imbalances, where central banks, the creditor nations, are going to be absolutely crucial to what happens next.
The crisis that followed the global financial crisis has shown that emerging markets have definitively emerged and taken their rightful place among the other traditional asset classes. A fact that is not only intellectually intriguing, but also has real implications for investors worldwide.